Hey everyone, so it's Dan here again, and I'm with Andrew Acosta. So he's one of our preferred lenders here with Century 21 Edge at PRMG, and thank you so much for coming by and doing this here. So interest rates is always something with buyers that they're interested in, and you always hear it about the news. So I wrote a blog that kind of does a deeper dive into what actually goes into what affects the interest rates. Obviously, we're not talking from a consumer level. We're talking more from like the government and what controls that. So Andrew, I know there's a lot that goes to it, but in your eyes, just kind of a really big overview, what affects interest rates?
Sure. So the three main things, just looking at top down, that can really go into rates is three things. The economy, number one. If the economy is doing well, rates tend to rise because they know that people can pay more, spend more, all that stuff. So it kind of goes with the flow in that sense. When the economy goes down, then that means they want to incur spending, so they're going to lower rates in order to have people borrow more and kind of goose the egg a little bit. Second thing is inflation. It tends to, as inflation rises, rates tend to rise with inflation. You saw that after the 2020 COVID pandemic, and now you're going to see inflation coming down. You're going to see rates come down as well. And then the third thing is the Fed. The Fed doesn't really control rates as much as people think. However, they do tend to lower or raise the Fed funds rates, which can in turn affect other rates in the economy that can kind of trickle into borrowing costs.